So hi, my name is Muhammad Asri. In this video, my group and I will present about our group assignment. So for this assignment, our group have chosen Aeon Co Berhad and Parkson Holding Berhad, two companies operating in the retail industry and both listed on the main market of Bursa Malaysia. The retail industry is highly competitive and dynamic, making it a suitable sector for financial ratio analysis and performance comparison. We selected this company because they are among the most prominent department store and mall operator in Malaysia, each with a substantial presence and long-standing history in the market. So, Aeon Co Berhad is a leading retailer and mall operator known for its department store and supermarket across Malaysia. It is part of the larger Aeon Group originally from Japan and is involved in retailing, property management and customer services. Aeon focus on providing a wide range of product and a consistent shopping experience. Meanwhile, Parkson Holding Berhad is an investment holding company established in 1982 with retail operation in Malaysia through its subsidiary Parkson Retail Asia Limited, which operates 38 department stores locally. Apart from department store, PHB is involved in food and beverage, property development, consultancy and even customer financing through Parkson Credit. By analyzing these two companies using solvency, efficiency, leverage and profitability ratio, the study aimed to assess their financial health, operating effectiveness and long-term sustainability within the competitive retail industry.
Assalamualaikum, my name is Farami Shamira and I'm going to continue with the solvency ratio. Now, let's look at the solvency position of Aeon Co and Parkson Berhad over the 5-year period. Starting with the current ratio, which measures a company's ability to cover short-term liabilities with short-term assets, Parkson consistently recorded stronger liquidity, increasing from 0.86 in 2020 to 1.05 in 2024. Aeon, on the other hand, started much lower at 0.35 but showed gradual improvement, reaching a 0.70 in 2024. This indicates Aeon is strengthening its short-term liquidity but still trails behind Parkson. Moving on to the quick ratio, which exclude inventory from current asset for a more stringent test of liquidity. Parkson again lead with a stable increase from 0.73 to 0.90, while Aeon remains low, rising from just 0.08 in 2020 to 0.34 in 2024. This suggests Aeon relies heavily on its inventory to meet obligation, which may pose risk during slow inventory turnover. Lastly, the cash ratio. The most conservative measure shows Parkson maintaining higher immediate liquidity. Its cash ratio improved from 0.36 to 0.60, while Aeon increased from a very low 0.03 to 0.24 by 2024. While Aeon is progressing, it still lacks the cash buffer Parkson has. In summary, Parkson Berhad maintains a stronger solvency positions across all three ratios, indicating better liquidity management. Aeon Co is catching up, but its lower quick and cash ratio suggests it remains more vulnerable in the short term.
So next, I will proceed with comparative analysis of efficiency ratio between Aeon and Parkson companies. Let's begin with the average collection period. In this ratio, the lower value is better. So Aeon performed excellently, reducing its collection period from 13.16 days in 2021 to just 5.16 days in 2024. This shows that Aeon collect payment quickly, improving cash flow. In contrast, Parkson's collection period is worsened significantly from 46.54 days to 76.26 days, indicating inefficiency and possibly poor credit control. So next is inventory turnover ratio. The higher value are better as they reflect good inventory movement. So in this ratio, Parkson leads here, especially in 2020 and 2021 with turnover up to 12.56 times. Although it declined to 8.40 by 2024, it still outperformed Aeon. Worsen turnover remains stable between 6 and 7.5 times. Next, on receivable turnover, Aeon again excels, increasing to 70.76 times in 2024, indicating rapid conversion of the credit sales into cash. Meanwhile, Parkson ratio dropped to just 4.79 times. So moving to fixed asset turnover, here Parkson performed better with the value ranging from 1.5 to 2.28 compared to Aeon's 1.17 to 1.40. This suggests that Parkson is more efficient in utilizing its fixed asset to generate sales. Lastly, for total asset turnover, Aeon outshined Parkson once again with the ratio between 0.66 to 0.79, while Parkson lags between 0.31 to 0.50, indicates Aeon better in managing its total asset to generate sales. So in conclusion, Aeon demonstrates stronger performance in most efficiency ratio, especially in receivable and overall asset utilization. But Parkson, however, performed better in inventory and fixed asset turnover.
Now, let's take a look at the leverage position of Aeon and Parkson Berhad from 2020 to 2024. Starting with the debt ratio, Aeon shows improvement by reducing its reliance on debt from 0.73 to 0.74. Parkson's debt remained higher and stable around 0.74, indicating heavy use of liabilities to fund assets. Next, the debt to equity ratio. Aeon steadily lowered its ratio from 2.65 to 1.91, showing a healthier balance between debt and equity. Parkson's, however, stayed high from 2.98 to 2.82, suggesting more financial risk and dependence on borrowing. Moreover, Aeon's equity ratio increased from 0.72 to 0.34, while Parkson's remained flat around 0.25, meaning Aeon is slowly building a strong capital base. In terms of long-term debt, Aeon keeps it lower around 0.30 to 0.38, while Parkson's stay above 0.40, pointing to greater long-term financial commitments. Finally, the time interest earner ratio negative for both companies. Aeon's ratio worsened from negative 1.74 to negative 3.08, while Parkson dropped from negative 0.20 to negative 1.22. This is show both companies are struggling to cover interest costs with Aeon in a weaker position. In summary, Aeon is gradually improving its leverage structure, but its interest coverage is concerning. Parkson remains more highly leveraged and financially exposed overall.
Hi, Assalamualaikum everyone. My name is Wan Wak Mizami 109. Today I will present a profitability ratio to comparison between Aeon Co and Parkson Berhad over a 5-year period from 2020 to 2024. We're looking at three key indicators: net profit margin, return on asset, and return on equity. Let's begin with the net profit margin, which measure how much profit company makes for every ringgit of sales. For Aeon, we see a steady increase from 1% in 2020 to 3% in 2024, indicating consistent improving profitability. In contrast, Parkson margin improved significantly from negative 18% in 2020 to negative 5% in 2024. Although this reflect substantial reduction in losses over time. In summary, Aeon is already profitable, while Parkson is on the recovery path. The next profitability ratio that we compare is return on asset, which tells us how efficient the company used its assets to generate profit. Aeon returns of assets increased from 1% to 2%, a sign that it's improving its operational efficiency. Parkson also improved from negative 6% to negative 2%, but still below the break-even. This suggests Aeon is making better use of its assets compared to Parkson. Lastly, let's look at return on equity, which measure a return generated on shareholder equity. Aeon showed impressive growth here, from 2% in 2020 to 7% in 2024, indicating a strong value creation for a shareholder. Parkson, however, remained in negative territory, from negative 23% to negative 6%. Although the trend is upward, this reflects that Aeon is in a stronger financial position in terms of generating returns for its investor. In conclusions, Aeon outperformed Parkson across all three profitability metrics. It showed a consistent growth, efficient asset use, and strong shareholder returns. On the other hand, Parkson is still in a recovery path with negative but improving profitability. Overall, this ratio indicates that Aeon financially healthier, more stability, and positioning in more favorable on the future growth.
To sum up, Aeon Berhad has shown a better efficiency and profitability compared to the Parkson Berhad. But in terms of solvency and leverage ratio shows that both companies have a similar financial performance. Aeon Berhad measured a great average collection period ratio, indicates that they converts their accounts receivable into cash efficiently. A shorter average collection period suggests quicker payment processing and a better cash flow management. Also, a higher in receivable ratio generally indicates efficient credit management and faster collection of payments in Aeon company operation. Hopefully, in the future, Aeon and Parkson can improve the ability to meet its long-term debt obligations and remain solvent over the long term, so that company's cash flow is sufficient to cover its long-term liabilities together to generate profit from its operation relative to its revenue, asset or equity.